Hello, my name is Eamon Verdone. I am a member of Savant's investment research team, and I am here to provide a review of the markets for the first quarter of 2017. The first quarter was positive for stocks around the globe, but emerging market stocks rallied the strongest. Bonds were mixed this quarter, with U.S. bonds moving up and international bonds moving slightly lower. Meanwhile, commodities and managed futures both experienced a setback, but global real estate and reinsurance led alternatives with modest gains. The U.S. unemployment rate dipped to 4.5% after especially strong job creation months in January and February. Inflation ticked up to a year-over-year rate of 2.8% in the latest update, driven by price increases in energy, recreation, and apparel relative to early 2016. The fourth quarter GDP growth rate came in at 2.1%, down from 3.5% in the third quarter, but closer to our current sustainable potential GDP growth rate. The 10-year U.S. Treasury yield ended the quarter at 2.40%, down slightly from 2.45% at the start of the quarter. Shortly after President Trump's inauguration, the Dow Jones Industrial Average closed above 20,000 for the first time ever. In February, economic growth continued overseas, helping to boost markets globally. And in March, the Fed raised interest rates by 25 basis points just 2 weeks prior to the UK triggering Article 50, which officially kicks off Brexit negotiations between Britain and the European Union. U.S. stocks continued their post-election surge, with the S&P 500 returning 6.1% during the quarter to lead the way. U.S. small and small value stocks slowed, but did still generate positive returns. Focusing on the last 1 and 5 year periods, we can note that across all asset classes, U.S. stocks have produced exceptional returns. Developed international stocks fared even better than U.S. stocks during the first quarter. While the value premium did not prevail this period, international large value and international small value still fared quite well, with returns of 6.0 and 7.6% respectively. Over the past 5 year period, investors who diversified by including international small stocks in their portfolio have been rewarded with a tremendous premium. Led by its small cap stocks, emerging market stocks provided the highest first quarter return of any asset class at over 11%. Frontier markets have lagged the greater emerging market stocks over the past few years, but have contributed positive excess return over the last 5 years. Moving on to bonds, inflation-adjusted bonds led the way due to increasing inflation expectations. Investment-grade corporate bonds helped drive short and intermediate-term bonds to positive returns as credit spreads provided a cushion against expectations for higher interest rates. However, bond returns have slowed over the past year as we progress into an increasing interest rate environment here in the United States. Alternative assets had a mixed fourth quarter. Commodities and managed futures fell by 2.3 and 4.1% respectively. Meanwhile, global REITs and reinsurance provided positive quarterly returns. Over the past year, commodities and reinsurance have led the way for our alternatives, with returns of 8.7 and 6.4%. Next, let's look at the asset class returns together. The portfolios on this slide illustrate the hypothetical performance of different global stock and bond mixes of indices. As shown on the bottom left corner, the hypothetical investor with 100% stocks would have fared the best during the past quarter with a 6.5% return. However, more diversified portfolios with an allocation to emerging markets would have performed even better during the most recent quarter and year, although the data is not shown on this chart. While larger allocations to stocks have more risk and volatility in the short run, they do have higher expected returns over time. The growth of $10,000 chart illustrates this well, as each riskier portfolio has provided a greater return on the initial investment. The blue line shows how an all-stock portfolio has had the most growth over time, while a mix of stocks and bonds, such as the green or yellow lines, has had growth but with less volatility. Alternative investments, in different structures and forms, have been around for quite a long time. However, historically they have only been available to large institutions or endowments and the ultra-wealthy. As markets and regulations have evolved, these alternative investments have become available to more investors. This makes it increasingly important to conduct thorough due diligence before investing in any alternative. But when properly researched and utilized, alternatives can be used to mitigate risk and/or enhance return. At Savant, we have been exploring and building on our alternatives allocation for over 15 years. Continuous diligence on both new and long-standing alternative options remains imperative in constantly changing capital markets. For a deeper dive into Savant's alternative investment philosophy, check out our latest white paper. Staying diversified and fully invested is a time-tested strategy. Do not allow short-term volatility to impact your allocation and jeopardize long-term returns. The U.S. economy is continuing to strengthen as employment data, inflation, and GDP growth are all approaching Fed targets meant to foster a thriving economy. Meanwhile, attractive international stock valuations should continue to provide a benefit to diversified investors over the long haul. That wraps up the first quarter of 2017. Thanks for listening.